All right, so let's get started. Today, we are focusing in on the life insurance conversation that we started a couple videos ago. This one today, we're going to talk about life insurance as a retirement plan. There's a lot of words on this screen. The ones that I really want you to focus on are life insurance as a retirement plan. It's a strategy that utilizes permanent life insurance. Typically, it's a permanent policy. Well, it's always a permanent policy: whole life, universal life, indexed universal life, variable universal life. Those are the four real main types that a LIRP strategy, but it's built to provide retirement savings benefits in addition to the death benefit that's typically associated with life insurance. Key features are tax advantages. So we're looking for tax-deferred growth, and we're looking for access to the cash value in a tax-efficient manner, in a tax-free manner. The death benefit, obviously, always a component of life insurance, has to be there. We're looking for cash value growth, and we're looking for flexible access to funds. LIRP strategies, life insurance as a retirement plan strategy, are considered to be a more advanced financial strategy, and it may not be suitable for everyone. If you are being sold a LIRP strategy and you are not funding this policy to its maximum possible potential, if you are only funding it to the target premium, and I'm going to show you that here in a second, you're being either sold a LIRP strategy just to line the pockets of your life insurance advisor, life insurance agent, or you shouldn't be looking at a LIRP strategy at all. Remember, what we're trying to do is we're trying to buy the lowest amount of death benefit possible for the maximum amount of cash value accumulation. You need to make sure you're talking to a competent and trustworthy life insurance agent. Otherwise, they're gonna make a huge commission and you're gonna get pissed off and it's not gonna work the way you want it to work. That being said, let's kind of dip in. And now I've showed you this before in a previous video. In fact, this video right here, it's either gonna be here or here on the screen. But this video right here, if you want to watch this one to give you a setup for what I'm showing here, I've shown you this before. So this is a prospective client of ours, and we were in a competitive situation with them. And the financial advisor or life insurance agent was showing $400,000 a year in premiums being paid in. So this is my example of showing $400,000 in premiums being paid in out of pocket by the client. And we showed 1, 2, 3, 4, 5, 6, 7, 8, and then I think I've got 9, 10, 11. So 11 different strategies showing the client paying $400,000 a year out of pocket directly to the premium. And the death benefit is not high, a $5 million death benefit on the highest policy, down to a $4 million policy at the lowest. So this is relative to a $400,000 premium. A $5 million death benefit is not a lot of death benefit. If those numbers are too big, then say a $40,000 premium for a $500,000 policy. Think about that for a second, or go even lower, $4,000 premium for a $50,000 policy. Look at what you're being sold right now. And if those ratios aren't the same and you're putting in a significant premium for what you can afford and the death benefit is substantially higher, you're being sold something you shouldn't be buying. It needs to be redesigned and you need a different life insurance agent. But I'll keep continuing on this $400,000. And this is what my clients were being showed: a $400,000 strategy. They were going to put that money in for 13 years. They were going to take distributions to supplement retirement, life insurance as a retirement plan. And this guy was projecting $500,000, $560,000 a year of distributions. In our strategy, without much work, our distributions were $600,000 a year, $673,000 a year for one of the higher performing carriers that we designed this for. So think about it. Let's set the stage. $400,000 a year for 13 years. It's a healthy number. But again, your number's your number. Whether it's $40,000 a year, whether it's $4,000 a year, they happen to be in the ballpark where they can do $400,000 a year for 13 years. But the distribution of $673,000 is something to consider starting in year 14, carrying on for the rest of that person's life. It's a very intriguing story, but I know what the naysayers are going going to say, John, life insurance isn't a good vehicle. Life insurance is expensive. Well, we're going to compare it to a traditional stock investment here in a little bit, but I wanted to show you what that looks like. Now, when we properly apply leverage to this, and Archimedes said, give me a lever long enough and a fulcrum on which to place it, and I shall move the world. What he's talking about here is leverage. With the proper amount of leverage utilized in a controlled environment, you can really do some incredible things when it comes to finances. And so in this example, we're going to apply that amount of leverage using bank financing for the premiums. So instead of a $400,000 a year premium payment, let's apply that $400,000 a year in a interest payment. So it really changes the structure of the design. We have our life insurance details here. We've got the policy premiums for 10 years being paid in, and this is a 56-year-old male. Again, $400,000 a year out of pocket is nothing to sneeze at. That's a healthy number. But in this example, when applying $400,000 a year to bank financing using leverage, we're able to get a bigger policy, we're able to get more cash value into that policy, and we're able to take distributions of $722,000 a year for the rest of their life and life expectancy, and we're able to increase the size of the death benefit for their beneficiaries. So if I go back to the original design, this guy was showing $400,000 a year, only taking out only $565,000 a year, but the death benefit would shrink from an $8 million death benefit all the way down to a $2.5 million death benefit. In the designs that I was showing over here, we were going to have a $5 million death benefit, but those two would start to get smaller and smaller as we would take these $673,000 a year distributions. But when you apply leverage, like Archimedes says, the proper amount of leverage, not only are we able to exit the bank loan in 13 years, completely eliminate the bank loan. I'll show you another example here in a second where we don't eliminate the bank loan, but we eliminate the bank loan, $722,000 of tax-free distributions. Client puts in $400,000 a year for 12 years, then takes out $722,000 a year for the greater part of 20 years. Think about that. That's an incredible distribution. And then the life insurance itself is elevated, not dropping below $7.5 million. It's a tremendous opportunity for the client. Now, here's what it looks like when you don't exit the bank loan, keeping that proper amount of leverage. Those distributions go from $722,000 a year to $1 million a year of distributions, income tax free. Think about that. This is like a Roth IRA, a life insurance retirement plan, or a LIRP strategy when properly designed is like a Roth IRA on steroids. Most of the people at this level cannot contribute to a Roth IRA. They're phased out because their income is too high. But this individual can put these contributions in and take out anywhere between $700,000 to $1 million a year of distributions, and only has to pledge collateral for 1 year of $230,000. And what that means is when the bank loan is greater than the cash value of the policy, banks want two things. They want interest and they want collateral. In this example, because the interest payment is so high, we're able to pay down that loan quite a bit. And he's only exposed to collateral for 1 year of $230,000. So he pledges a money market, a CD, or a letter of credit for the 1 year of $230,000. And every year thereafter, based on the assumptions that we have in this design, the cash value in this column is larger than the loan value in this column. So he always has positive equity starting in year 2 of this design. So people would tell you, you don't want to borrow money. Well, the question is, do I not want to borrow money when I'm broke? Yeah, that doesn't make sense. You don't want to borrow money for assets that depreciate in value, but you do want to borrow money. There's good debt and then there's bad debt. This is good debt, right? The other thing is it's okay to borrow money when you have the ability to pay off the person or the institution that you're borrowing money from at any given point in time. And so this individual who has the financial wherewithal gets to make a decision each and every year. Do they want to keep borrowing money from the bank at a lower rate, and keeping their assets invested at a higher rate, so long as we can have that positive arbitrage in this design. So then we come to all the naysayers of life insurance. Life insurance is too expensive. Life insurance doesn't work. Well, the alternative is, instead of this individual borrowing the money, we're going to assume that they're going to take that same premium amount and invest it into a brokerage account. Now, these are the stock market returns from 2010 through 2023. So it's a 14-year window of time. These are the actual returns of the S&P 500. The actual 16, 32, 13, 1, 11, 21, -4, all the way down. 22 was a -18%. 23 was positive 26%. Great year in the S&P 500. Now, we're going to apply the traditional 1% management fee to this, and we're not going to take taxes into account on this. So that is an actual rate of return over that period of time of 13%. Not bad, right? But we're going to apply the 1% management fee, so they actually only got a 12% return. That's with the comparison to life insurance that I'm about to show you here, okay? Go to the next page. Policy A, I imported all of the policy premium. Now, mind you, my client's not paying the $930,000. They're only paying $400,000 a year for the 12 years, not the $930,000. But we'll show this as the client paying $933,000 a year. But look at all of these horrible life insurance fees that are applied. Premium charge, policy fee, expense charge, cost of insurance charges. I mean, it totals to $1.9 million over the first 10 years. But the alternative is, if you don't use life insurance, you have to invest that money. And the traditional way is to use a brokerage account, invested in stocks, bonds, opportunities to grow. But this one, the assumption is it's all invested in the S&P 500. So client puts in $930,000 of their own money, gets a 12.78% return in year one, gets a 0% return in year two, because that's what happened in the stock market in 2011. Then it gets a 13% return, a 29% return, and a negative 0.73%. Again, actual returns from the S&P 500. But here's the funny thing about it that no one in the financial advisory space talks about is, what is the true cost of that 1% management fee? What is it really doing to the performance of your account? And how does that compare to a life insurance policy? Look, here in this example, in the 8th year, only 8 years does it take for the investment account, the safer, traditional, less expensive investment account, compared to a horrible, expensive, terrible life insurance policy. It only takes 8 years for the life insurance to become less expensive than the traditional investment account. Now think about that. And again, you don't have to be putting in $930,000 a year. It could be $93,000 a year. It could be $9,000 a year. It could be $900 a year. But when you properly design a life insurance as a retirement plan, this is the kind of the crossover. Now think about this. For the first 7 years, yes, life insurance is more expensive. Fine. Make it for the first 8 years, 9 years. Life insurance is more expensive. But after that 1% management fee becomes a drag on the performance of the equity account, right? It's not always better. It doesn't have an additional death benefit to it like the life insurance policy does, but it gets more and more expensive by a significant margin. And for those of you that want to see it in a graph, here's what it looks like in a graph. Policy A, the life insurance policy, is this blue line. It's expensive in the first few years, but it kind of levels out and becomes a very, very, very reasonably expensive or inexpensive vehicle. Tax-deferred growth, tax-deferred, tax-free access to the money when done the right way, tax-free death benefit. Look at the fees of the equity investment at a 1% management fee. It becomes astronomically more expensive, but nobody ever talks about that, right? A properly designed life insurance policy, if you can weather those early years, becomes one of the least expensive financial assets you can own in your portfolio, not to mention all of the other benefits that it provides. Remember, tax advantages to the tax-deferred growth, tax efficient to the distributions, the withdrawals, the cash borrowing, has a death benefit associated to it, flexible access to the funds. LIRPs can be an incredibly attractive tool when done the right way. Remember, IULs have 7 caveats, and we talked about this previously. If you didn't look at my last video about the right advisor, go back and look at that video on the advisor. But the 7 caveats are: you got to have the right advisor or agent. You got to have the right company, life insurance company to choose, the right product within that company, proper design, proper index strategy, proper funding strategy. And what we talked about today was the right use of the leverage. LIRP strategies can work. They can work beautifully. If you're not at this level, drop it down to a level and your death benefit should mirror that. It should fit into that. Do not be oversold a life insurance policy when you're not funding it to the maximum potential. But the comparison to the traditional investment account, the 1% management fee, is something you really need to consider. Like, subscribe, comment, share. We've got more information like this. This is valuable information that nobody's talking to you about. I'll see you in the next video.